So good afternoon, everybody, and welcome to a very different budget briefing. The first time we've hosted a digital version. I'm Brian O'Farrell, CEO of the County Carlow Chamber, and we look forward to delving deeper into the details of Budget 21, which you hear now. We're delighted to be running this briefing in partnership with Harney Nolan Chartered Accountants, and shortly we'll be hearing from Tony Harney and James Nolan, who will take us on a deep dive of the measures announced yesterday. So, how will this session work today? We want your engagement and input as it goes on, so please don't hesitate to ask questions as the presentations are taking place. You can do this by using the chat function on the bottom of your screen. We will also have time at the very end to have questions and answer sessions, and we can use microphones as well at that stage. I would ask you to keep your microphones muted throughout the presentations, but as I was saying, we can use them then afterwards. You can leave your cameras turned on. It's not a requirement, but it helps to make the event a bit more engaging and also helps for better interaction. This briefing session is going to be recorded and it will be hosted on the County Carlow Chamber website within the next 24 hours. So you can look back over any points again at your own convenience. And if you want, feel free to tweet details we're going through. You can remember to tag Carlow Chamber. Following yesterday's publication of Budget 21 by Minister Donohoe and Ministers McGrath, the Chamber of Commerce and the network of chambers across Ireland welcome the overall expansionary approach of the government to address the many needs of the most exposed members of the business community to the twin crises of Brexit and COVID-19. Under normal circumstances, with the economy performing as well as it has been pre-pandemic, we would be expecting a very different budget. But in the words of Ministers Donohoe and McGrath, the backdrop of Budget 21 is truly a remarkable one. In a series of submissions and meetings over the last while, the Chamber Network called for a budget which was centred on the theme of place, which would support businesses and trade through the pandemic by supporting liquidity, local economies, and the long-term investment needs of the whole economy. This is truly a budget the likes of we've never seen before, and we appreciate the challenges on delivering on every ask of the business community and society. But we do feel there are some missed opportunities. Investment in affordability of childcare, supporting entrepreneurs through reforms of corporate gains tax and other entrepreneurial reliefs. They could also have been bolder in funding the recovery for urban centres. There's an opportunity for the National Economic Plan to improve on this, and we'll continue as a network of chambers to push government on this use. And no change in tax relief for remote workers. There are some wins, and these we believe are the large expansion of investment in infrastructure, mainly in the areas of transport and housing, establishment of a Brexit and COVID fund, 3.4 billion, new reduced VAT rates, and extension of commercial rates waiver until the end of this year, with a 300 million of shortfall to be funded by central government, to mention but a few. So this is where I'm going to pause and hand over to our experts, as they need me to leave some measures for them to cover. And as always, the devil will be in the detail. First up, I'm delighted to introduce Tony Harney of Harney Nolan Chartered Accountants. So Tony, I'm all over to you.
Okay, can I share my screen at this point?
Go for it, it's all yours, yeah.
Okay. Well, good afternoon, folks. Pity we couldn't have met earlier this morning over the rashers and sausages, but that's the year that's in it. Thank you, Brian. Thank you, Colin, for Chamber for hosting this. And so together with my colleague, James Nolan, we'll give you our take on the budget. Hopefully there'll be something, some takeaway for you in it. And if you only walk away reassured that you knew it all, there's something in that as well. When I meet people that I haven't met for a while, the mantra is strange times. It's a bit of a cliche at this stage, and I suppose regrettably we're meeting fewer as we try to reduce our social contacts. But in money terms, these are indeed strange times. because despite COVID and despite the world economy going to hell in a handbasket, our little country can borrow for free or even at negative rates and seemingly without limit. And despite the massive hit to the economy in terms of employment, the income tax take is not going to be significantly impacted. Paschal reckons that it'll be down about 2% on expectation in 2020, which is kind of bringing home to the government as well as to the rest of us that the income tax take is that a huge portion, virtually all the income tax is paid by higher earners, and that the unemployment such as it is impacting lower earners, part-time people who weren't paying tax in the first instance. And despite the hit to the economy, the corporation tax take keeps growing and becoming a more and more significant part of the tax take. It's up, I think, something like 20-ish% in 2020 on expectation, up to about 12.5 billion. It's now towards 20% of the total tax take. And while that's fantastic and is all a positive effect of a certain clamping down on tax avoidance by the FDI sector since about 2013, it has meant that they're paying a lot more tax, and all of it in Ireland for the moment. But it's a piece of the tax take that is under tremendous threat from Europe, from OECD changes, and it's not going to go on. It's not going to stay as fine for our government in this space. If we could take ourselves back to, say, 13 years ago, 2007, when we were all Celtic tigers and tigresses and Celtic cubs, we could have had no idea that we'd be hit by two once-in-a-lifetime events. And the response the last time, while on the monetary policy side, central banks did their part in terms of keeping up money supply and keeping down interest rates, the response this time has been twofold, because the central banks have continued on that path, but on the fiscal side, governments have, whereas the individual governments, the last time they were all about what became known as austerity in terms of trying to balance the budgets. This time, the view is let's borrow at these negative or flat interest rates and spend to get out of this problem, which will hopefully be a temporary problem. The issue for Micheál, McGrath, and for Paschal, I'd say, is a question of how much to borrow without scaring the horses. So their starting point was that when things were normal in 2019, and by normal I mean no COVID and no Brexit, so for the first time, I say since 2007, they brought in a surplus of 1.3 billion. First time they brought in a surplus. But having done so, say at the beginning of this year, our little country had what it proudly calls a rainy day fund, and you'll hear that Paschal is about to raid the rainy day fund, because if ever there was a rainy day, this is a rainy day. But it's really only what I call soft talk, because it doesn't amount to a hill of beans. Like the rainy day fund is only 1.5 billion euro. On the other side of the balance sheet, our national debt at N19 was 200 billion, which is a significant sum. Economy going well, but that is a significant sum. In terms of borrowing and how much they might borrow, the EU constraints and the euro constraints seem now to be obsolete, at least temporarily. So since the euro was introduced, say 20 years ago, in order to stay a member of the club, a government had to run an annual deficit of below 3% of GDP and ensure that its total borrowing was below 60% of GDP. Now, when I say ensure, the idea was that this is the band within which you should be. And if you were outside this, you should be able to show Frankfurt that you were on a path to getting back inside these parameters. So what this year, despite the amount of extra money the government have had to throw at the problem, it looks like the deficit this year for 2020 will come in at 20 billion. I think strictly about 21 odd billion, but I'll say 20 billion to keep in nice round numbers. And that would be about 6% of our GDP against a 3% target. And our debt would then be 200 starting out plus another 220 billion, which would be about 57% of GDP. So I suspect that in terms of the ministers' joint decision making, they've decided that, well, in order to keep it level, keep it look like we have a handle on this, they decided to pencil in borrowing of another 20 billion, the same as the 2020 outcome, and no difficulty justifying that in the context of COVID, in the context of Brexit. And you'll all recall that just a few months ago, when we had an election, all the clamour was for let's fix health issues, let's fix housing issues and fix climate issues without regard to how much money it would take and where it would come from. So the spending will be in all of those areas. And in truth, Paschal's boss isn't Micheál Martin nor Ursula in Europe. He's really answerable to the bond markets. And I suppose what he has to keep an eye on is how will the bond markets look on borrowing, and from an Irish perspective. And the blue column is GDP. The orange column is the 2019 relativity debt relative to GDP. And out on the right hand side in the red column, I call it bad. So traditionally, if your debt to GDP was 120%, that tended to be a marker you're walking into trouble. So you can see that our 2019 debt, and even as it goes up in 2020, and even as it goes up in 2021, will still be snugly below safety levels. So the ministers really can take the view that for the moment, there's no bother borrowing lots of money. So having borrowed this money, if we looked at budgets in recent years, the minister would explain how they split the budget between changes to tax and changes to spend. This year, taxes are substantially unchanged. There are no changes to income tax. There are very, very insignificant ones in monetary value. There are changes to VRT. We'll call it a green agenda. At a glance, I don't see that it's going to make huge change. So the change is all on the spending side. And they've included in that 20 billion, a little bit like if you were putting up a building or building a house, you'd be advised to put in a contingency sum. So that they've included some billions on areas that they don't know what they'll need to spend it on yet, but they know that with COVID unresolved and with Brexit coming down the tracks, that we will need money in areas that they cannot yet identify. So the idea is that this spend will have a positive impact on the economy, and that the government will keep the pump primed and take up the slack that COVID and Brexit will cause. Our own experience here over the last few months, looking at our clientele, would be that, with the obvious exception of hospitality and tourism and high street retail, that businesses are actually doing all right. Like, you wouldn't have to be a genius to work out that those areas are going to be hit hard. But the surprise for me is that other areas are doing reasonably all right. Now, that's obviously with the aid of the various government supports, the temporary wage subsidy scheme, we call it the TWSS, the restart grants, the current wage subsidy scheme, and the amount pumped in through the PUP. If I can talk a moment about the TWSS, the temporary wage subsidy scheme, should be history at this stage. We've had the benefit of it. It was the big beast in terms of pumping money into the economy. Later in a moment, James will talk about the working out of it from an employee perspective. But from an employer perspective, there's a little bit of working out to be done, in the sense that employer has had the benefit and now typically is going through a process of justifying to revenue that employer, that the business was indeed eligible for the scheme. Back in July, revenue, I won't say, well, it was kind of a threat, but they said that they would put every employer through the hoops on this, get every employer to justify that they were entitled. And at the time, they really only reached on, I would say, less than 10%. But in the last 10 days or last 2 weeks, they have sent out a slew of letters to virtually every, to the other 90-ish%. Demanding against a tight timeline of a proposed 5 days, that the employer would explain why they claimed it and justify their eligibility. There's another piece of it by the end of this month, where every employer will have to report to revenue on the amount of subsidy paid to every employee in the scheme. That will result in a reconciliation process whereby revenue will say, well, okay, you've told me you've paid X to all your employees. I know as that revenue have given you Y, so X minus Y will typically result in an overpayment. The way the scheme was structured in the early days, the subsidy paid out by revenue was €416. It was the max, irrespective of whether the entitlement was 350 or sometimes less. So it's almost inevitable that every employer is overpaid at this point. So from here on, if they haven't already gone through what I call the compliance letter, so justifying their eligibility, they will then have to report on the amount paid, then agree that they have been overpaid, and then sometime next month repay that amount. My last line there is that we were told yesterday in yesterday's budget that if your business cannot afford that repayment can be warehoused in what they call their tax warehousing scheme. So in the early stages of the COVID trouble, if I call it that, revenue introduced a warehousing of tax scheme, whereby fiduciary taxes, by which we mean taxes not on your own income, but taxes that you collect on behalf of the government from your employees and from your customers in the form of PAYE and VAT. It's okay if you can't afford to pay those. It's okay to withhold them for a year at no interest cost. And after that, as you enter into a repayment scheme, an interest rate of 3% will apply. We were told in yesterday's budget that this scheme will also apply to your upcoming income tax filing. So income tax returns that you'll be dealing with and your accountants will be dealing with in the coming weeks with regard to any balance of tax for 2019 and any preliminary tax for 2020. Those are also covered by the warehousing scheme. So it means if you can't afford it, you don't have to pay it with no interest penalty until this time next year. Obviously, it's only a deferral. It's an interest-free loan in effect. I'll touch then on the current employment wage subsidy. We found in our experience that a big number of our clients availed of the first one, and it was the big beast. I would think of our clients who have availed of the temporary one, less than 10% will avail of this one. Because thankfully, while a good few of our clients were able to say, well, during that lockdown period, we had very little turnover in April and May, and then we were coming back in June. So to meet the 25% marker, that drop in turnover, that was a threshold that many businesses did meet. But the threshold for this one is that you've got to believe that you will be 30% down in top line for what I call H2, the second half of 2020, as by reference to the same period last year. And we're finding that not many of our clients are in that position. So this one has far less impact, far less impact. So while the TWSS pumped a lot of government money into the system. This one has far less effect. And even where it applies, the amount per week, that the subsidy per week is a max of €203, which is the unemployment benefit rate. It's obviously less than that if you pay less than that, and if you pay less than €151, I believe there's no subsidy at all. We learned from yesterday's budgets that there's another of these acronyms, a CRSS, called a COVID Restrictions Response Scheme. It will apply to sectors impacted by restrictions, and it will apply where level 3 or higher is in place, which obviously is the current position. So if I'm running a business and I cannot do business because level 3 restrictions are in place, then I can put my hand up for this. It's called an advanced credit for trading expenses. I'm not so sure what that means or why they call it that or what's the relevance of calling it that. To avail of this, you need to be doing no business or at max 20% of the business you did for the equivalent period last year. So I say your turnover needs to be down by 80%, not down to 80%, down by 80%. In such circumstances, you'll be paid 10% of turnover, being turnover in the reference period last year, 10% up to the first million of turnover, and I believe 5% thereafter. And you'll be paid up to a max of 5,000 per week. And it's my take that if your business benefited from this, you could benefit from this and in parallel benefit from the wage subsidy scheme. And it is in place with immediate effect and in principle up to 31st March next year. So if I give you a little worked example, so if a publican has a turnover of €750,000, that wouldn't be, you could certainly run a business on that. That wouldn't be an indecent turnover for a pub. I'd say for a family business, not for a large pub. And let's say restrictions are at level 3 or higher and are at that level for 8 weeks, then that business would be able to put its hand out for 10% of 750,000 divided by 52 weeks would be €1,442 per week, or for a period of 8 weeks would benefit to the tune of €11,500. And if I give you a little example, where you run above the million and therefore impacted by the lower 5%. In this example, I say, let's say a restaurant with a turnover of 1.5 million, and you have level 3 for a period of 5 weeks. I think as I ran on with this example, forget the 5 weeks, I just expressed it in an amount per week. So on the first million, 10% of that and divided by 52 weeks, that's €1,923 per week. On the next €500,000 at 5% divided by 52 weeks is €481. So that business would get €2,400 per week for the duration of the restriction. I talked for a moment about the Restart grant. Again, no more than the TWSS, this should be history. And similar to the TWSS, the eligibility criteria were similar to the TWSS. But I have found, to my disappointment, that despite the amount of information that is out there, put out there by Chamber, put out there by the local enterprise office, in our own case, we did a seminar on this, a webinar on this stuff, hosted jointly with Chamber. We sent out emails and more emails, and on our Harney Nolan app, which you can download for free, we've sent out over 20 notifications around these various supports. And yet I have found that I have clients, good clients, business-like people who didn't claim their, who certainly missed out on the first Restart grant. If your house is in order, you should have benefited, and if you were eligible, you should have by now benefited from the Restart grant, which is essentially a refund of your 2019 rates. You should have benefited by what's called the Restart Plus, which is your 2019 rates all over again, with fewer restrictions this time in terms of turnover and so on. If you are of Laois, Kildare or Offaly, you should have benefited by a further 40% of your 2019 rates. And all of that in the form of a rebate, money into your bank, so to speak. And then we learned yesterday, well, we already knew that with regard to 2020 rates, they are rebated initially for 3 months, then for 6 months, and as of yesterday for 9 months. So let's say you have by now paid your 2020 rates in full, well, then you are due back a credit against next year, or a rebate if you put your hand out for it, of 3/4 of that. Interesting with Brexit on our doorstep that COVID comes along and puts it kind of in the halfpenny place. But remember, it is happening. And we talk about deal or no deal, which sounds like a poor man's television program. But if there's no deal, we all know enough to know that a business will be done on WTO terms. If there is a deal, it'll be on the basis of a free trade agreement. But what does that mean for importers and exporters? To my take on it is that the main difference is down to the level of customs duty. But either way, there's going to be cost and bother around all of this. UK will have left the single market. So in terms of procedure, it's the same as you're importing from China or anywhere else outside Europe. So you're going to have all the procedures that go with that in terms of your SADs, your single administrative document. You will have customs duty in the case of WT. In case of no deal, you'll have customs duty. In the case of free trade deal, presumably in most instances, no customs duty. You will have VAT at import. You will have the cost and bother of all of that, and probably question as to whether it's affordable and is there a better way of getting this stuff, or can you source it somewhere outside the UK? If you haven't already sorted out these things, you will need, like, I suppose my question is, have you got your EORI? Have you got your economic operators registration and identification? No point showing up in Rosslare and say, I want to import X, and sure, we've been doing this for years. They'll only know you by your EORI. I'd ask you, in terms of what you're importing, and I'm looking kind of from an importer's perspective at the moment, do you know the tariff classification of the goods you're importing? And do you know it with certainty? And bear in mind that if you import something, and let's say it gets to you and you have paid revenue, your VAT and your customs, and your haulage company, or better still, your customs clearance agent has determined on your behalf what customs duty you pay. Bear in mind that customs duty is just like any other tax. It's on a self-assessment basis. And if that duty rate, if the tariff classification is wrong, and you pay, say, at 5% when in fact you should have paid at 12%, like any other tax, it's like self-assessment, and you are open to subsequent audit, and revenue could come in 2 years' time and say, hey, I see you paid at 5%. The duty on those goods should be 12%. You owe me the difference, plus interest, plus penalties. And this isn't a responsibility you can hand off to the haulier or to your customs clearance agent. It is like everything else. It's down to you, the business. You've got to consider like VAT for most of us in business. In VAT registered businesses, VAT is not a cost. But if you have to pay the VAT when the stuff arrives at the port, there is a funding issue to be resolved. There is in place a VAT deferment scheme, might be new to many of you, whereby the goods can come in free of VAT and you pay it later. But to have the benefit of that, you've got to go to revenue, apply for it, and back up your request with a guarantee from your bank. So it's effectively putting in place a new bank facility. Importing and exporting is obviously very transaction driven. It's not our area. It's an area where if you need help, you need the help of a customs clearance agent. And that's a space that for the last, so I suppose really since the arrival of the single market, it's an area of shrinking supply and will be massive demand in that space. So whether you even be able to get your hands on a customs clearance agent as you need one in the coming weeks and months will be an issue. On that cheerful note, I'll end my presentation. I'll hand you over to James and I'll hang around and hopefully if you have questions, we'll be able to field them later on. Thank you, Brian.
Thank you.
Okie doke. Thanks, Tony. I think you should be able to see my screen. Hopefully you can all see my screen. Yep.
Yes.
Okay, I'll progress then. So as is kind of normal in these seminars we've given before, or webinars it is now, Tony maybe looks at some of the macro stuff and I maybe look at some of the micro stuff, and also I have a tendency to look at what's current, what's happening with revenue, what are they looking at, what's different, and just to give you a feel of what's going on there from a kind of a practical point of view. Now, this is a bugbear of mine. I always seem to harp back on this about the when people in Ireland enter into the high rate of tax, and even when you see what the minister said last year, where he made a comment about being competitive, and if someone enters the high rate of tax at a relatively low level, that it just you just can't be competitive as an economy, and you just can't attract employment, and you can't retain employment, perhaps, particularly FDI employment. And that is still where we are today, unfortunately. If you look at where we are, we're not Sweden with a high marginal rate of 69.7% combined tax rate, but we are 10th highest of the 36 OECD countries, with a 52% marginal tax rate, 55% for self-employed people whose income is greater than 100,000, because there's a 3% penalty on those individuals when it comes to additional USC. And where we are in the midst of COVID and Brexit also, COVID appears to have put paid to any hope of widening that income threshold, despite the fact that it was a government aspiration. If we have a look and see just where the tax take comes from and compare our tax take to our OECD neighbours, you can see the blue bar chart is our take, the green bar chart is OECD average, and you can see that we are way ahead when it comes to the take as regards personal taxes, income tax, profits on gains and such like. Corporate taxes, despite the fact of our low rate, and people give out about it, other European countries perhaps give out about it, our tax take is higher, but that's perhaps to do with the structuring of and who pays it and the small number that pay large amounts. You will see a huge disparity the other way around when it comes to social security contributions, and that's because our European neighbours typically employers would pay in those countries a much higher employer's PRSI contribution than we would pay, and the others are quite similar to each other. But you can see that seesaw effect where personal income tax in this country would appear to be a higher percentage than our OECD neighbours. So on the personal taxes, not much to talk about here, because it was well tipped from weeks and months out that there weren't going to be many, if any, significant changes to income tax. They definitely said there weren't going to be any increases in taxes. So just the small little changes that were there, and they are very, very small. The earned income tax credit, this is the credit that self-employed individuals receive. That was increased by €150 to 1,650, and that basically brings it now in line with the POIE credit that was there for employees. So they've been slowly chipping away to bring that up to parity, and they succeeded in doing so yesterday. There was always a tax credit there that was, in my opinion, was it was so low it was almost offensive. The dependent relative tax credit, €70 per annum tax credit, that has been increased to €245. It's still a very, very low tax credit, considering that it's supposed to be compensating people for looking after an elderly or a very dependent relative, somebody who can't look after themselves. And I suppose another important one to point out is the retention of the Help to Buy scheme, because it is a significant amount of money. There's a maximum of 30,000, or it's capped at 10% of the price of the new home for first-time buyers to get them onto the property ladder, and very important to have that. It's one that maybe a lot of people don't avail of. It's can be tricky enough as regards the process, but once you're in there, it should work out okay for you. It's much more straightforward if you're buying just a standalone house from a developer, from a builder. If you're building your own house, it can be a little bit more complicated, a little bit more form fitting to be done online, but it is possible, and people should be aware of it and definitely apply for it. So very simply, you can see there's the table of the main tax credits, 2021 versus 2020. The two bottom ones are the ones that changed. They're the uplifts, €175 and €150 per annum. The others, no change. So they're the exact same from one year to the next as regards to tax credits and the main tax credits. And on the bands, again, no change. So they are the thresholds from where people fall from the low rate into the high rate. No change of those from one year to the next. As I say, my bugbear is that they're too low compared to our OECD neighbours, or even the UK. Our nearest neighbour that we would often compare ourselves to. And with USC, myriad of different rates and thresholds of USC, but it's the middle one that there was some change on. The 2% rate, that band was widened by €203. And the only single logical reason for doing it, and they do it every single year, is to keep that band rate in line with minimum wage. So, but everybody benefits from it, not just people on minimum wage. So the bandwidth there, the 2% bandwidth, was increased by €203. All the other rates remain the same. And with our PRSI, again, a little tweak there with employers PRSI, and that again is to do with a matching of the earnings to minimum wage as well. And it has no impact on the take-home pay of the employee, but it does have an impact on the employer's cost. And just to throw in there, back in 2018, February 2018, there was a working group set up to look at the amalgamation of USC and PRSI, because it was a kind of an election promise at one stage that, we'll get rid of the USC. I think I said at the time, I'll eat my hat. I'll buy my hat and eat it if I see it disappear, because it collects so much money. It's a fantastic collector of taxes. Needless to say, nothing has happened on that since February of 2018 as regards that merging. Tony said that I'd have a little talk about this, and I think it's interesting to some people, particularly those that are employees or those that are proprietary directors that are paying wages through the POIE system. And we're a recipient of TWSS or PUP. So this was the first. The TWSS was the first wage subsidy scheme. So we have TWSS, we have EWSS, and now there's the new CRSS. But the TWSS was the one that was brought in first in March, April of this year. And there was people received the benefit of that money into their bank accounts without it being taxed at that time through the payroll system, even though revenue said it was a taxable source of income. So we all knew the tax was going to be caught on this at some stage, but the question was when and how, and what were the mechanics of it going to be. So only in recent terms, or recent days, revenue really have come out and said what they're going to do. So the mechanics of it are as follows. In January 2021, revenue will look back at calendar 2020 for everybody that participated in the TWSS or received a PUP payment, and they will issue them with a draft statement through their My Account, which is their Revenue My Account online account. And I'll talk to you about that a little bit more later on as well. And that statement will detail a kind of a provisional or preliminary calculation of the tax liability of that person for 2020. It will then prompt that person to go and make whatever various claims they believe they're entitled to in that year that they would normally claim or should be claiming anyway, such as ensuring that all their tax credits are in order, claiming for medical expenses, claiming for college tuition fees, whatever the case may be. You make that claim and then you process that return, and that becomes your final liability for 2020. So now that the liability is crystallized, which includes the liability on the TWSS, the question is, how do you pay it, or when do you pay it? And you can pay it immediately if you wish, and if you're so inclined, and if you have the wherewithal to do that, you can make a payment through the My Account system, and that's it, done and dusted. Or alternative, what Revenue are saying is that they will reduce your tax credits going forward over a period of 4 years to minimize any financial hardship that you may suffer. And that will only commence in January of 2022. So whatever liability arises, you will pay over 22, 23, 24, and out to 2025 on a straight line basis over 4 years. So that's interesting. I said, any employee out there, any proprietary director that's an employee, or even as an employer, you may be getting questions from your employees, and you might be able to, you can give them that answer. It's really only something that kicks off from January 2022. Looking at business taxes, very quickly, skirting through some of this, no change to the 12.5% corporation tax trading income rate, or the 25% corporation tax passive income rate on investment income and such like. For intellectual property acquired from today, a balancing charge, that's a tax liability may arise on its disposal. A balancing charge may arise on the subsequent disposal under capital allowance rules. So prior to that, there was no such tax charge to the extent that the intellectual property was held for a minimum of 5 years. So you buy it, it's an intangible asset. If you held it for 5 years and subsequently disposed of it prior to the budget yesterday, you didn't pay a balancing charge. You didn't pay a tax on that as a result of the balancing charge. Now it falls to be taxed as a balancing charge. Other business issues, minimum wage is currently €10.10, has been since the 1st of February, and that is set to increase only by a further 10 cents to €10.20 on the 1st of January 2021. There was a little bit of giving out in the media about it, that it was such an insignificant increase. Being cruel about it, unfortunately, a lot of the low earners that would benefit from that are possibly on PUP payment at the moment anyway. So maybe it doesn't affect people as radically as if we had a full workforce there at the moment. But it's definitely something, I suppose, the government are guided upon, and we'll look at it again, I'm sure, in the new year. Tony mentioned about this, so I won't go into it in any great detail, but there is the new scheme, the CRSS, for businesses that are closed because of level 3 and hit the 80% reduction in turnover. Just something, when I see the percentages, and it's something that came to mind to me today, the civil service, they were throwing a lot of work to do, and particularly, I suppose, the Department of Finance, to come up with a lot of these schemes and subsidy schemes and financial aids and COVID related reliefs. And there's a lot of thought put into some of it, but I do wonder sometimes how much thought is put into the percentages. Like the TWSS, in order to qualify, there had to be a 25% reduction in your turnover. The EWSS, there had to be a 30% reduction, but it was a different benchmark. It was a different period that you were benchmarking your 30% reduction on. And now we have an 80% reduction. So, I mean, how unfair is it, or fair is it to the guy who had a 75% reduction or 60% reduction? I do wonder sometimes, is there any logic or rationale? And if there was, I'd like to see what the logic and rationale is sometimes of the percentages that they pick for qualifying criteria. Another little thing that was mentioned yesterday is the self-employed people who are in receipt of the PUP payment are now going to have the opportunity of picking up some freelance work, so they can go and generate some self-employed income again to supplement their PUP income up to, it appears to be €480 per month. There's a little bit of facts to be confirmed on that yet, so details have yet to be confirmed. So Neo Varadkar apparently leaked it by a tweet before the budget even came out yesterday. I didn't see that, I'm not on Twitter, but and that's really where the headline was picked up. But the 480 figure has yet to really be confirmed, I believe. And Tony mentioned again that the tax warehousing scheme that has been expanded. It was only to cover VAT and POIE. It now covers your TWSS repayment and your 2019 and 2020 income tax payment. The thing to note maybe about tax warehousing is that if your turnover is below 3 million and you're defined therefore as a small case taxpayer, you're automatically in the warehousing scheme, whether you wish to partake in it or not. You are by default in the warehousing scheme. There's no formal application scheme. If your turnover is greater than 3 million, there is a formal application process you must go through to justify why you should be in the scheme. But if your turnover is less than 3 million, you're already in the scheme. So people are in it and perhaps don't even realize it. When it comes to capital taxes, no changes there on the thresholds, no changes in the rates. So CAT, your capital acquisitions tax, and CGT, your capital gains tax, rate of 33% remains. And the thresholds for CAT, as you can see there, no changes, no mention of that at all yesterday. When it comes to capital gains tax, small little change there, which is to the benefit really of a scheme known as Entrepreneurs Relief. And that was a relief that's available to anybody who owns at least 5% shareholding in their company, where if they subsequently dispose of their shares, they can avail of a 10%, a reduced capital gains tax rate of 10% as opposed to what otherwise would have been 33%. So previous to the budget, a person had to have their holding for a continuous period of 3 years in the last 5-year period immediately before the date of disposal. So you had to have it for a continuous period of 3 years in that 5-year window before you dispose of your shares. Now, once the shares are held for any continuous period of 3 years prior to disposal, you can claim the relief. So it brings a few more people maybe into the net that were otherwise excluded. I was speaking to a tax consultant yesterday before the budget, and he had heard a lot of rumours that entrepreneurs' relief was going to be removed completely from the tax legislation, that we were going to lose it, and obviously we haven't. But it's something that may disappear shortly. We brought it in this country because we followed a trend in the UK. UK brought it in and aimed it primarily at people in the IT world to encourage them to base themselves in the UK. So that if they sell on their developed app or their developed software, they could avail of the entrepreneur relief. We followed suit with a reduced, more constricted version. Then we increased the threshold up to 1 million. The UK pushed theirs up to 10 million sterling. But in talking to the consultant yesterday, he tells me that the UK did a review of the mechanics and how it works and a cost-benefit analysis on it in the UK. And the UK HMRC are not happy with it at all. They've reduced the threshold now there to 1 million sterling, and he believes the next move will be out the door, that it'll be gone completely. So if we follow suit, there's a good risk here that it will also be removed, considering that we brought it in the first instance just to compete with our neighbours across the water. So if they get rid of it, there's a good chance we will get rid of it here. When it comes to VAT and customs and excise, so you should be aware by now, as a result of the July stimulus package, that the standard VAT rate has already been reduced from 21% to 23%, just for a temporary period of 6 months from the 1st of September. So everybody should be aware of that now, that if you're charging VAT at the standard rate, it should be only at 21% for the next 6 months. As regards the 13.5% rate for the hospitality and tourism industries, anyone in that sector, the rate has been brought back down to the 9% rate that was there before. People that are in that world will understand that the rate was at 9 and then was brought back up to its standard 13.5, and now it's been brought back down to 9 again, with effect from the 1st of November until December 2021. And just maybe two things to say of that. One, I have in there on the slide, the 9% rate is still almost twice the rate of the that's applicable for the same industry in the UK. It's 5% currently in the UK. They have a temporary reduced rate there as well, but it's 5%. It was brought in their budget there a few weeks back. And the other thing to say is that unfortunately a lot of the businesses that this rate applies to are closed at the moment. So hopefully they won't be closed for much longer, but they cannot benefit from it unless you're open and trading. So it's a little bit unfortunate, perhaps. increase in the farmer's flat rate, the refund of VAT that they can claim has increased marginally from 5.4% to 5.6%. The all reliable, the 20 cigarettes on up again by 50 cents. I could leave that slide there, I think, and it has been the same for the last X number of years. I could leave it there probably for next year, up by 50 cents. The only danger now is they reckon a packet of cigarettes is so dear that it's prohibited for anybody to buy them in a legitimate manner, and that it kind of drives them away and makes them almost so expensive that people will even revert more to the illegal tobacco routes that are out there. So there is a kind of a tipping point maybe there that we have reached. No changes when it comes to excise on alcohol. The Green Party in government, this is their electoral promise, and I suppose that the other parties have also bought into this, that there would be an element of increase in carbon tax. So it's a €7.50 increase in carbon tax. Immediately you would have felt it at midnight last night with the increase in your petrol and diesel. Petrol I think went up by 2 cents a litre and diesel by €2.50. I forgot to fill my tank, simple mistake. But anyway, there you go. But there's more of this on the horizon, and it's going to be expected. It was promised, and there's really nothing we can do about it. It's just going to happen, and it's going to cost us money, unfortunately, until there are alternatives to carbon burning energy generation. I think Tony touched on this about a revamped VRT mechanism that's been brought in for the motor and a revised motor tax regime. It's been based on a new emissions test. That'll all be introduced shortly. The new VRT will be in with effect from new car purchase and registration on the 1st of January. Hopefully it won't impact too significantly on the price of vehicles, but again, it's being used as a stick to beat people away from the traditional petrol diesel model and towards the electric vehicles or the hybrid vehicles. When it comes to spending, this is the largest, I believe it's the largest spending budget in the history of the state. 87.8 billion is the total of the spend that's earmarked. And even at that, could it be bigger? It might be. When you think about some of the comments maybe that were almost like throwaway comments that Paschal Donohoe made yesterday, he was talking about the EWSS that we were told was going to end on the 31st of March 2021. He then told us that, well, it wouldn't end. It'll continue on into December 2021 and maybe on, and sure, we'll just look at it and see how it goes. I mean, when you make a comment like that, it's very hard to budget for that kind of statement. You know, is it going to be from March 2021 to June 2021, or is it going to be to December 21? Who knows? Or even is it going to go on further, or is it going? What scale is going to have, or how many employers are going to be participating in it at that stage? Are they going to change the criteria? It's a strange world that they're in at the moment trying to budget, but that looks like the figure 87.8 billion, and that's what they announced yesterday. Some of the big ticket spend, there's an allocation of 5.2 billion for the delivery of housing in 2021. There was pressure to act there from previous promises that were made and previous budget statements. There's an additional 4 billion extra spend for the health service, and we can understand that there's always a demand there, but even more so because of COVID at the moment. And then, of course, we mentioned COVID and Brexit. There are contingency funds there totaling 8.5 billion earmarked for businesses to help spend our way out of it and protect ourselves and protect business as much as possible. So that's kind of the budgetary stuff for the moment. If we just look at revenue commissioners, what's topical, what's going on there, what's new? We would have mentioned in the past at other talks POI modernization, and any employer that's out there is familiar with how the POI system now works. It's a real-time online system. 2019 then was the first full year of that. And if we look back at 2019, we can see that part of the requirement in the whole POI modernisation process was that employees had to take responsibility, much more so for their own tax credits and for their own commencements and terminations of employment, to make sure that their record was correct, because to not do so meant that they could be financially penalised with their taxes. So at this stage, we have 2.6 million people registered on the Revenue My Account, which is the online facility for POI individuals. And there is no way in hell that they would have got 2.6 million people to register for that facility, only for POI modernisation. So it has worked out to be a fantastic coup, really, from a revenue's point of view, to get that many people, that many employees, 2.6 million registered on My Account. It now means that those people need to use My Account for all of its benefits. And as I say, when those that were on the TWSS are being reviewed for their tax liabilities, it is through My Account that they can look at that process and manage that process, and they will see how their tax credits are being affected from 2022 onwards and those 4 years out. And they can make whatever various claims they need to make to limit their tax liability, if that's the case. So those 2.6 million people, they're up there now. They need to make use of that, website. As I say, fantastic number of people up there. There were changes, and I mentioned this, I think, in previous seminars, that there were new organizational structures completed in 2019, and I suppose the revenue haven't really had the benefit of a proper year to roll out those improved structures because of COVID hitting so early in 2020. But I think when things come back to a norm, that will be rolled out fully. Tony mentioned this already. Employer TWSS reviews are currently taking place. What I'd say to employers is, if they haven't heard anything from their accountant or their agent, check your Ross inbox, because there will be a letter more than likely there saying that you've been selected for a review, a compliance review, and the letter will also tell you you've got a 5-day reply deadline. It's a very tight deadline. You can contact Revenue and ask for an extension, but they otherwise are looking for you to come back and explain yourself within a 5-day turnaround. And I put in working from home, us and them, and question mark, is it the future? Well, us and them, us being ourselves, them being Revenue. Revenue at the moment, from what we gather, the vast majority of them are working from home. Some are coming into the office. The working from home thing, from a practical point of view, is not really working out. We hear GDPR is a huge issue. Taxpayers' data is so private and so important to them, and the GDPR regulations would prevent a lot of this data leaving the tax office premises. So there is a hindrance, and there's limits being put on the amount of work that the revenue officials can actually do from their kitchen tables. Ourselves, we're working from home, and a lot are still working from home. Just to point out that an employer can compensate an employee by an amount of €3.20 a day as a tax-free payment. It's not huge, but it can be paid from employer to employee for those that are working from home. There was no change in that in the budget. That has always been there. And those that are working from home can claim an element of their domestic light and heat and telephone, and now broadband charges, that was confirmed in the budget yesterday, as an expense of their employment. So that can be done through My Account if they're registered for My Account. So both those little bits are interesting. They're not huge in number terms, and there is a guide up there on the Revenue website to explain how the utility allocation should work, and the limits that are to be applied there for any employee that's making such a claim. Another arm of the state that relates to tax is the Tax Appeals Commission. So you end up in the Tax Appeals Commission if you've received an assessment of tax that you disagree with Revenue on the basis of it, on the scale of it, or how you were assessed, or how you were how that liability came to arise. So you end up with dispute, not on payment, but a dispute on the assessment itself. And it is often a technical issue, and it has to be addressed by somebody. There has to be a judge, for want of a better word, and that judge sits in a place called the Tax Appeals Commission. And it was in utter disarray up to 2016. There were only 7 staff in there, and they were drowning in the sea of appeals that were coming in, and they were getting nowhere fast. They weren't even treading water. So the government invested a lot of money in the Appeals Commission to try and make it a fit for purpose. There's currently 28 employees now there, as opposed to 7. There are a number of more tax appeal commissioners employed. Some are ex-revenue officials. There are some temporary tax appeal commissioners in on short-term contracts to try and work through the process. The minister even touched on this yesterday, and he was pleased to say, that the TAC was making progress, and he was pleased with that progress. But I would say, however, when I look at the numbers and I look at the statistics that are there, the number of appeals that were standing at the end of 2019, which is the last full year that we have a report for, were 3,370. 3,370 cases were open, hadn't been touched yet. So some cases were being worked on, but those cases hadn't even been touched yet. And the quantum, the tax value that is in dispute between the taxpayer and the state is 3.79 billion on those cases. So if those amounts are real and they're really owed and should be paid to the state, well, it's almost a duty that the state should go and sort those blooming cases out and collect that almost 4 billion. If it's not, it's 4 billion of a relief that the taxpayer should get confirmed to him. But unfortunately, we're not anywhere near getting those cases heard, because since 2017, I went look back at all the statistics, and the TAC is only concluding 50% of all appeals received in a year. So not only is there the snowball of appeals coming forward, they're only able to close 1 out of every 2 cases that they receive in any year. So the snowball is still gathering a pace behind them. And what is that? The rate of appeal is coming in at 125 on average per month. So it's a job of work that yet has to be solved. And the fact that they're not there is reflected in the fact that the Tax Appeal Commission are not even paying out their annual budget. They have a budget of 3.2 million and they only spent 1.7, just over half. So they haven't really geared themselves up to the full extent. That budget is there. They're probably one of the few departments in any government, of any part of the government, that is not spending its budget. So when you look at revenue activity in 2019, and we see who revenue we're targeting when it comes to audits and interventions, and compare that to the previous year, 2018, top of the pile is always our friends in the construction industry. But you will see as you come down that there has been a marked reduction in the amount of audits and interventions from 18 to 19 across all the industry heads. So like 16,000 odd in 18 down to 14,000 in 19, and so on and so on. And the reduction in the audits and interventions has resulted in a reduction in the yield. And you can see that again. It's quite evident that the yields are down. So one would wonder what was that about? Was revenue putting resources into other things? Was it about its restructuring in 2019? The 2020 figures will be interesting to see, but of course we're in the midst of COVID, so audits and interventions have basically been stalled at the moment. So it'll be the interesting statistics have yet to come out of 2020 and maybe onwards as to where revenue are going with their audits and interventions. But at the moment the trend seems downwards, which is unusual. If we look at revenue activity from those audits and investigations and see how much they actually collect in money terms across the type of interventions, again, you will see the trend is down. So the total audit interventions being 3,029 in 2019 with a take of 222 million. And in 18, it was 4,735 with a take of 255 million. And then the overall interventions are marginally down to 566,000 versus 580. And again, the tax take, the value, the yield is also down. The one thing that bucked the trend there on the yield was the risk management interventions. There's a slight buck in the trend there. This is always an interesting thing, just to pat ourselves on the back to see how compliant we all are as taxpayers. No surprise really, because of POI modernisation, 99% of POI and PRSI is returned and collected on time. VAT very similar, income tax very similar. Capital gains tax is always behind the curve by the very nature that people find out sometimes in arrears that they had a liability to capital gains tax, and by default they end up being late. So 91% there is 98 and 99% for corporation tax and RCT. Every year, Revenue do some random audits. So Revenue audits in the main are come about as a result of some risk analysis program that they've run, and some flag shows that there's an indicator of something that needs to be investigated. But they also do some random audits. But you will see in that instance that the 2018 audits were 1,300 and 2019 were only 150 as regards to sample size. And the yield out of the 150 sample size of the 70 that completed was only €472. So not exactly the greatest return from a cost benefit analysis there. Only 2 cases out of the 70 that were completed yielded anything, and they were €472. So if there's anything that should be coming from that, is Revenue should be saying, waste of time doing random audits. Let's put our effort into doing the risk-driven audits. If there was any statistic to show that there was an uplift in construction industry, this one shows it. This looks at the volume of RCT, or registered contract tax contracts and payments for 19 versus 18. And for every new contract, and mainly we're talking about construction industry here, for every new contract, Revenue have to be notified of it. And in 2019, the number of contracts was 665,000, which was up 48% on the previous year. And the number of payments then subsequent to the contracts were 1.6 million, which was up again 59% on the previous year. So a huge increase in the volume of activity when it came to RCT, which can only mean a huge increase in activity for the construction industry, 18 versus 19. And just to put a few more stats in there, the number of POI and employments, and that's not employees, because one person may have a number of employments, but just over 3,183,000 employments, registered employments in 2019, and that's up 8% on 18. 793,000 people registered as self-employed, which was up 9%, and 212,000 odd companies registered for tax, which was up 5%. And they were all very, very positive trends, you would have to say. The more taxpayers, the more tax, the more taxpayers, the more activity that's going on out there. But if you remember the number I said about the My Account registrations at 2.6 million, and you see the POI employments at 3.1 million, and if we say a number of those, 3.1 are multiple employments for one person, you could probably hazard a guess that the vast majority, if not all employees, are registered on My Account. So my conclusions are fairly straightforward when it comes to tax and the budget. Self-employed taxpayer will on average be better off by about 155 per annum in their take-home pay. That's because of the additional increase in the earned income tax credit and a saving in USC. POI workers, they will get the saving in the USC, which is only €5 per annum. That's all very, very insignificant, but no surprises there. We weren't expecting anything. Social welfare recipients, there's a broad increase across the board there. I haven't gone into them in any detail, but increases for lots and lots of headings under social welfare for social welfare recipients. We mentioned it already, COVID-19 and Brexit, they're the 2 big ticket items, and there's between 8 and 9 billion earmarked in this budget for both of those contingencies. And there has been, and there will be, significant spending across all the departments, capital spending, investment in health, be that an investment in education, be that an investment in employees, or be that as regards capital spend. And just to finish on a one-liner, often try and find something just to, you want to call it half humorous. A fine is a tax for doing something wrong, and a tax is a fine for doing something right. Whoever said it didn't even want to put their name to it. So that's me finished. I'll hand back to Brian if he has any questions. Thank you.
Thanks very much, James. And I know we've got a couple of questions that popped in there while we're talking. We've got one there from Stephen. If an employer is availing of the TWSS, are employees meant to cease making pension contributions while under the scheme? And does the employer element continue as normal?
So you're saying that if an employer is under the TWSS?
Yeah.
Well, the TWSS is finished now. It's the EWSS that's in place at the moment, and the EWSS is a much simplified process. It doesn't actually impact on the employee's wages at all. It's more akin to a grant per qualifying employee paid to the employer. So TWSS is over and done and dusted at this stage. It's EWSS is what's relevant now, and that shouldn't have any impact on an employee's wages.
Yeah. And the other questions that we had, I know somebody had asked about an extension on the reconciliation date for TWSS.
I see that question, Brian. I'm not aware of any extension on that.
Yeah.
And I see a question before that about the CRSS scheme. A bit confusion on who qualifies for the scheme. Any of these are the TWSS, the EWSS, there can be confusing. I mean, let's say we found that the TWSS introduced last March, introduced on the hoof, and it went through dozens of iterations before all the detail was understood and out there and fixed. My sense, this one, it's around being, you cannot do business because the restriction, because Michal and Simon says we're at level 5, therefore close your business, therefore. So I give examples of pubs and restaurants, but equally if I'm selling, I have a man's shop on the high street, and if I'm told to shut down, I believe it will apply to me. So it's driven by the fact that you cannot do business because government says close down. And I suppose, and within that you cannot do business. So for example, if Harney Nolan were told to close down, we could still do business because because of the nature of what we do, we could do it from home. Personally, I prefer to do it from the office, but we could do it from home.
I think it is one thing we've seen quite a bit through the pandemic is, some of the information and clarification of criteria takes a couple of days then. So, as we get more details, we'll be able to share it. Just on the commercial rates, just something I was going to add in and remind people as well. I know a lot of people, so they had the letters with the 6 months, and now we're up to 9 months off the 2020 commercial rates. We will be asking the council for further details and even to clarify, but to remind people, especially in County Carlow, you can get a further 5% off of that 3 months that you are due under the rate incentive grant scheme, and that's where balances are discharged before the end of this month. But we will be in touch with the council and that, because to ensure that details are turned over fast enough to allow people to be able to discharge, or whether they can potentially extend that. But that's something else to remind people as well, that on top of the 9 months you can get a further 5%. It's always good to know where you can get some extra.
And Brian, in that space of commercial rates, I said earlier that it absolutely pained me that some of my clients had missed out on the first one, despite all the information that's out there. They are obviously not alone, and I gather it's under consideration that there may be an appeal scheme. There may be an opportunity, not as of this moment, but there may be an opportunity to go back into the local authority and say, oops, I missed the first one. Can I come in for it now? So
yeah, that's under restart grant, isn't it?
Yeah.
Actually, if I could come in on the restart grant, that's also extended from last week by an additional 30%. Once we went into the level 3 restriction, that kicked in. So you'll be able to apply for that in the next week or two. So it's an additional 30% on the 15,000, I think, that was offered originally in the Restart Plus.
And Niall has just asked about work remotely during lockdown. Any details on tax credit allowances for the broadband costs?
Yeah, I had just briefly touched on that. Firstly, there's the €3.20 per day that an employer can pay the employee. But as regards the tax credit allowances, an employee can work out a calculation themselves based on their own utility bills and allocate a percentage of that as a tax credit against their employment income. There is on the revenue website details of how you do that calculation and the max limits and the percentages you can take of your annual cost. Up to yesterday, broadband wasn't allowed as an allowable cost. Broadband is now allowable as a cost to be used. Prior to that, it was just basically light and heat cost were the utilities that you could use as regards the cost that you can put in as a tax credit if you're an employee working from home. But now you can use broadband. But there is on the revenue website, there is a guide to assist employees in working out that calculation and to inform them as to what the max amounts are. So you basically, in a nutshell, you get your utility bill and you work out a daily rate, then you work out how many days you're working, and then there's a cap as to the amount that you can claim against that as regards the percentage of that daily rate being for your tax credit.
There has always been a principle in tax that a PAYE worker can claim expenses, the expense, like if there is an expense that just without incurring it, he or she could not carry out her duties. So in the language of wholly, exclusively, and necessarily, that principle has always been there. So this is in that space. The principle tends to be policed quite narrowly. It's a difficult space to get anything across on revenue.
Yeah, you're right, Tony. That was always there. I think what revenue discovered was that when they did look at it, where people were abusing it, and they were saying, I'm spending half my time at home and I want half my electricity bill and half my heating bill, which is not really appropriate to somebody who's in one room of a building in their house for maybe 8 hours in a day. So they had to put an e-brief out there to guide people. Now there will be exceptions. There will always be exceptions, because you may have plotters or you may have heavy duty printers or something going, and you can revert back to revenue and make an exceptional claim. But there is a guide in an e-brief there for people. They'll find it on the revenue website, or I can circulate it through the chamber if Brian wants it. And it gives the parameters for, if you want to call your standard stay-at-home worker working on a PC.
Excellent.
There was one thing I meant to say just when we were talking about such big numbers, and it was something that came out yesterday when we were talking about the government spending, 20 billion extra this year and 20 billion next year, and will it ever be repaid, or how are they ever going to pay it? To match that on the other side, perhaps the savings ratio is also going up at an alarming rate, and they reckon that 11 billion additional euro was saved so far this year by people who just have continued to get paid their normal wage and have no outlet to spend their money. So there's 11 billion and more building up in what the government hope will be a slush fund, that when all this debt has to be paid back, there'll be hopefully lots of economic activity as that money is released and flushed into the Irish economy, and taxes and so forth are spent on it, as long as it all doesn't go to boohoo.com or wherever.
On that score, Brian, I'm predicting that when we get this vaccine, we'll have a repeat of the Roaring '20s.
We know what happened after the Roaring '20s, though.
Yeah, prohibition.
We had a depression.
I know Mary had asked there about Colin's statement on the 30% on top of the Restart Grant Plus. So the claims will be opening in Carlow Leo in the next week. And Jane was just saying about the commercial rates. Yeah, it is. It's up to the end of this month, but we'll go back to the council anyway as well, and we'll speak to them and see if there is some way they can extend it based on the details that have just come out. I know we'll be pushing them to get things turned around as fast as possible on that.
There is also, for anyone who doesn't pay, sorry Brian, there is also a small payment for anybody who doesn't pay rates. There is a small restart payment you can receive through the Department of Social Welfare. So you go to your local Intreo office or download the form to your local Intreo office. So anybody who doesn't pay rates for whatever reason, they can make a claim for a small restart grant through the Department of Social Welfare.
I see, Tony, you just mentioned Brexit earlier on. Just wanted to say to other people as well, there's a mountain of work if you haven't started preparing for it to get done. And one of the things I would recommend, there is Brexit preparedness courses which are running through the Leo. I was having a look when you were talking. I know that one or two of the upcoming ones are already fully booked out. They have got space on the one on the 1st of December. It'll probably be full by the time we finish this now. But it takes people through some of that process. But if you've got any other queries on it, you can come back to us in the chamber as well. But I would recommend the Brexit preparedness course and with the Leo. Is there any other questions? Does anybody want to come in? You can turn your mics on if you want to and ask any more questions. I think from us, thank you very much for taking the time to join us. I think it's been a very informative session, very different session, you know, very different budget than we've ever seen before. Thanks very much to Tony Harney and to James Nolan. You know, and we've held briefings like this over the last number of years. I think this one has been a very different one given the budget that we've just released and seen. But thank you for taking the time. I will arrange to send out link so you can play back on this session, and we will have some notes from the guys and that attached as well. So we'll have all that out to you in the next 24 hours. If you do have any questions on anything that was discussed today or any other things that come up in the budget that you're not sure about, come back to us and we'll get the answers for you. But for now, keep safe, and we look forward to speaking to you soon. Thank you.
Thank you, Brian.
Thank you.
Thing, we can forward you a copy of our client budget briefing, which you can make available to anybody.
Perfect. Thank you, Tony.
Thank you.
Thank you, Brian. Thank you, Colin.
Thanks, Tony.
Thank you.
Thanks, James. Thank you.
Bye.